Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 12th of February. And last week I foreshadowed the fact that the S&P index was on the cusp of confirming a breakout, and that certainly happened during the week. And we also saw continued strength, particularly in the resource area, but also in technology, which just continues to set new high after new high. So it's a very positive landscape at the moment, but I must say that, and I read a lot from around the world, that it's against a backdrop of media and fund managers increasingly turning negative on the market, trying to call a top in the market, and I guess this happens a lot when a market has been advancing for a lengthy period of time, but it's even more so now because so many people are against Donald Trump and what he's doing that it's really become a very loud noise of negative commentary about the market. But against that, the market just keeps rising, and that's what we need to stay with the trend until it ceases to be. So let's take a look at the action for last week. The S&P advanced by a further 19 points, so another new all-time high above 2,300, and that certainly confirmed the tentative breakout that we had the week before. The majority of people, and I've got a couple of charts to show you, the majority of people are still disbelievers in this rally and really have been since 2009. There's been a few little periods when people have become a bit more positive on the market, but generally the level of confidence and enthusiasm for the market just hasn't been there all the way through. And now we've got many hedge fund managers, some of the biggest names in the business are really speaking out about what they see as the risk of Donald Trump. So it's a very interesting scenario, but I must point out that some of these hedge fund managers have been spectacularly wrong of late. You know, George Soros has lost $1 billion on betting against Trump since the US election. So just because these guys are famous and supposedly they've got a good track record doesn't mean that they're right all the time. In fact, far from it. So I'll come back to that point at the end of the video. Now, the earnings season progresses. We're probably 70% through now, and it's been really solid for technology, healthcare, industrials, and financials in terms of not only the revenue and profit growth, but also beating expectations. It's been a really solid earnings season, and in general terms, it certainly justifies the current PE multiple for the S&P. So, again, there are plenty of people out there who will trot out various ratios that prove in their mind that the US market is at an all-time high valuation and therefore at high risk. It's just actually not true. They're just cherry picking the data to suit their argument, which is to try and make a name for themselves by calling a top in the market. So you really just want to ignore these people and just stay with what is. Now, whilst the earnings season has been great for a lot of sectors in America, it's been not so good for consumer sectors. Consumer staples has been a bit below expectations, and consumer discretionary has been quite a bit below expectations. So that's something that I am watching closely, because obviously the consumer is extremely important to the US economy. So that's one little question mark there. But look, certainly we have a technical breakout in America. There's no question about that. And so don't fight it. Don't try and pick the top. Don't try and second guess the market. And for heaven's sake, don't try and go short, or I don't think there's any necessity to hedge your exposure. That will come during 2017. I'm convinced of it. But while the market continues to move higher, just don't fight it for now. And we've got no sense at all of euphoria in the market. And that's what creates a top, when everybody believes that the market is inevitably heading higher, and therefore they start to put all their money in and there's not much money left to go in. That's what creates a top. You just don't get tops under these sort of psychological conditions. So in the short term, the market is a bit overdone. It could advance for another few weeks, maybe even another few months. But you need to be thinking about the fact that there will be a pullback. Of course there will be. But I believe after that pullback, it'll be a buying opportunity and then there'll be new highs in the market. So I remain bullish for a lot of fundamental and technical reasons. Now, there's no question that Donald Trump remains both a positive and a negative. His policies, some of his policies, will undoubtedly be good for the American economy, particularly around the tax cuts if he can get them through, and I suspect that he will, at least in part. Negatives, of course, surround the trade protectionist policy, and no one really knows how bad that would be, but it's pretty certain that it's not going to be helpful, that's for sure. But look, just don't waste too much energy on focusing on the negatives. Just keep it really simple. The market's going up. There are certain sectors that are going up more than the balance of the market. So just focus on them. You know, this is not rocket science. Just keep it really simple. The only other point that I would make is that the VIX has been at a very low level for a long period of time, and we do know that the VIX will eventually revert to the mean. It's currently down around the 10-11 mark. It averages around between 15 and 18. So I expect that we will see a bounce in the VIX, which means a pullback in the market. But again, let's wait until we start to see some more positive signs of that. Now here's the charts I spoke of. So you can see in the blue line is the institutional confidence 1 year out, and the orange line is what individual retail investors and traders see. Now you'll notice on both lines that and this goes from 2001, you'll notice on both lines that they're in or have been in long-term decline. So in other words, since 2001, people have been getting less and less confident about where the market will be 1 year out. However, you'll note of late that the institutional confidence looking forward has suddenly shot up and is basically at 15-year highs. So that's where the buying is coming from. Institutions are buying the market. That's what's pushing the market up. It's not the retail investor. The retail investor hasn't changed their viewpoint on the market yet, and that's why I remain, quite comfortable that we're not about to see some sort of long-term top in the market. You would need to see the individual right up there for that to occur. And here's looking at it the other way, and this is confidence that there won't be a crash. Now that level is now turning down again. After 2008-9, you can see that it was extremely low. So people were only about 15% of people were confident there wasn't going to be a crash. There was a recovery in that to around the 30 to 40% area through 2012 to 15, but you can see that it's come off the boil again. So people are increasingly concerned about a crash. And again, that is just not where you see market tops occurring. So my advice for the moment is just relax, just go with it. It's a very productive market. It's very profitable, and so you stay with it. Let's take a look at the Australian or the American market first of all. So this is the S&P index basically on a monthly chart, and you can see that we just continue to advance very strongly with really no sign of a move to the downside. You can see that we're almost to the top of the channel. We're also overbought or getting close to overbought on the RSI, but equally you can see back here the RSI was overbought from April of 2013 to March of 2015. So it was overbought for nearly 2 years. So the fact that the RSI is overbought and we're at the top of the channel actually doesn't mean a whole lot, because you can see during this period here, we just basically hugged the top of the channel, the RSI remained overbought, and the market just kept rising. So that's the big picture on the S&P. Looking a little closer, you can see we had a period of consolidation here which started in early December, really continued through until about a week ago. And then we started to get a bit of an upward drift and then a breakout on Thursday and Friday. So the US market looking really good. Let's take a look at the VIX index. This is actually the VXO, so this is the VIX on the top 100, and you can see just how low we are if we put a trend line through where we are currently, and then we pan back. You can see there's not too many periods where the VIX index goes lower. There was one very brief period here in 2014 when the VIX was lower. So we really are at all-time lows, and as you can see, they don't tend to stay down there very long. We get spikes. So these spikes are associated with a pullback in the market, and you can see how frequently those spikes come along. It's been a little bit since we've had one of those spikes. The last one occurred in November of 2016. So I think we'll probably see something of that nature in the not too distant future. Now, the US dollar, at a medium to longer term point of view, has been strengthening from the low 90s, got to nearly 104. We then backed off, broke through 100, but then strengthened again in the last week, not by much, but by a little bit. So we're still just hanging around this critical 100 level, and the jury remains out on whether the US dollar goes higher or lower. Common sense and fundamentals, or common thinking and fundamentals, would indicate that the US dollar should rise because the euro and the yen should be weaker, but that doesn't guarantee anything. So I remain quite neutral on currency at the moment. Turning now to Aussie stocks, the Aussie dollar was steady at 76.8, and that's against the US dollar rising a little bit. So I think that was still a bit of influence from the quite strong Australian trade data and stronger commodity prices. The ASX 200 index is just bouncing around. 2 weeks ago we were higher by 100. Last week we lost 95. This week we've put it back on again. So for 3 weeks we've just gone up and down, and medium term our market at the index level is doing nothing. And to be honest, at the individual stock level, there's very little trending. There's some really small cap stocks that are trending, mainly resource stocks, but that's about it. And if you compare that to global markets, the Australian market really is a bit of a sad, disappointing place at the moment. So just for the sake of the record, let's take a look at the first of all, the Aussie dollar. You can see no real change in the last week, and we remain within this big trend channel towards the peak of that channel. And just to look at the ASX 200, so we broke out above this key 5,600 point level. We broke out above that level on the 21st of December, advanced a couple of hundred points, come back, retested it several times, and basically we're just bouncing up and down and net not going anywhere. Turning now to precious metals, because there's certainly been more action here than just about anywhere else. And precious metals, the whole sector is looking seriously good again now. Now, look, I know the experience of a lot of people with precious metals has probably turned some of you off because we had an amazing advance in the first half of 2016. The sector got a right smashing in the second half of 2016, but net, it still made a very, very healthy profit. The problem is for most traders and investors is that they were slow to come in, so they didn't gain the benefit of the gains in the first 6 months of 2016. I was recommending entry into the sector to members, as they would know, in early February of 2016. So we actually made some very nice profits through to July at the peak. Backed our exposure off somewhat. In hindsight, I wished I'd gone further, but at least we took some profit off the table. The second half of the year was then pretty ugly, and that's when a lot of people had ramped up their exposure. They hadn't really got the benefit of the profits in the first half, and then they kind of refused to sell out and reduce their exposure quickly when the market was screaming the signals at us. And this is just normal human nature psychology. It's unavoidable, and it's why most traders and investors need some sort of sounding board assistance so that they can resist those kind of psychological temptations. But look, having said all that, precious metals really are looking good. We're seeing further confirmation in the ETF market. We got down under 800 tonnes in GLD a few weeks back. That's now bounced back up sharply to 837, and that basically follows on from the turnaround we've seen in the speculative futures market as well. So the money definitely flowing back into the sector now. And I really encourage you, if you are going to go back into the precious metals, then be decisive and do it now. Don't be shy because you might have been singed in the perfect storm that we had in Q4. The three parts to that, of course, were Brexit, Donald Trump's election, and then the Fed decision to raise interest rates. Each one of those caused a sharp cascade of selling in precious metals, partially manipulated and partially forced because futures sellers are so highly leveraged, they really have no choice, irrespective of their view. But if you're going to be in the precious metals market, resolve to be decisive. Get in early, take some profit when the market is indicating that it's going to turn back down again. And you just can't wait and see how it unfolds and wait until you get comfortable. Because if you do that in both directions, you're going to be on the worst end of the trend most of the time. Now, I expect the price advance will be hugely volatile. There's just so many cross currents at the moment in the markets that Donald Trump is basically amplifying. But potentially, I think this next run in precious metals is going to be quite massive. So I've become really quite bullish on precious metals again. It's definitely not a sector for the faint-hearted, but it does offer massive wealth building opportunity, that's for sure. Now, gold was higher by $15 on the week. We'll take a look at that chart, and that was despite US dollar strength, so that's a real positive. And just from a fundamental point of view, gold stocks and silver stocks, or gold stocks in particular, but to a degree, some silver stocks, remain highly profitable throughout 2016, even back in 2015 and 14. The common thinking was that gold stocks profitability must have been awful. In fact, it wasn't. The gold companies have done an excellent job of getting down their costs and getting down their debt. And these stocks now are even more profitable. And as the gold price moves up, which I'm reasonably confident it will do, then the profitability just goes through the roof. So this is not about speculation in stocks going up. This is about really good, solid fundamentals. So let's just take a look at precious metals. There is gold on a weekly, so you can see from where this whole bull market started in January of last year, which was around about the 1060 mark. We're now at 1235. It'll take a bit of work to get back to the peak just under 1400, but I think we're on our way there now. There's the daily chart, just to give you a bit more detail, and silver looking really solid. Silver is actually in the last month or two has actually outperformed the gold market. Now, looking at GDX as a proxy for gold stocks, you can see really good strength there. We've had a terrific run up. We just went sideways, no pullback at all. Another advance, and it's looking very robust indeed. Other commodities, copper advanced very strongly to 276, and again, that's despite the US dollar going up in the last week. Copper advanced from 261 to 276. And the stocks are really supporting the strength. They're leading the way in the underlying metals. So it's looking very good in that sector. Crude oil was unchanged at 53.8. We did get a dip, but then a recovery. And crude oil remains stuck between 52 and 55. They're the key levels on crude oil. Energy stocks had a terrific run in the latter half of 2016, which was really a recovery from those excessive selling lows, but they've been weak so far in 2017. So the question is, Is this just a consolidation before the stocks advance, or are the stocks telling us, as they quite often do in the resource area, stocks telling us that there is a correction in the underlying commodity about to come? Again, I'm not sure. I'm probably no better than 50-50 on this. I think there's every chance that oil could correct back down to 45, particularly as Trump is intent on absolutely revving up the US oil drilling industry. So under those circumstances, we could see oil back at 45. Equally, it could break out and head towards 60 and 65. I'm 50-50. So I think some exposure to energy stocks is okay, but probably best to do it on a dip. There's the spot copper chart. You can see really quite a nice advance in the last week. So wrapping it all up, ignore the gurus, for goodness sake, because some of them have recently lost billions of dollars on drastically incorrect views. So a lot of people, members and others send me articles of various famous people that have made big statements about where they think the market is going. Just ignore them, because they're often wrong, and you really don't know what their agenda is. So I think trying to unravel some sort of edge from reading that stuff is it's just not helpful. As I said at the start, just keep it simple. Also, there are so many people who are just talking their book to sell you something. All the people that have an advantage if the market were to fall are constantly, and I get them. I get a lot of material from all around the world deliberately. So I see a lot of this stuff, and they've been calling a top in the market for 3 years and left an awful lot of money on the table. Just a point of reality, as I mentioned before, a mean reversion on the VIX in the near term, sometime in the next 2 to 8 weeks. You've got to expect it. I think it's unrealistic not to expect a bit of a pullback in the market, but that doesn't mean that the trend is going to change. The final thought I'll leave you with is that the greatest risk to our success is us. It's what's going on between your ears. Don't be gullible and follow the media. Just stick to your own plan and stick to your own discipline, and that's been extremely profitable over the last 3 or 4 years. And just go where the greatest degree of probability is. The Australian market is doing very little. The American market is going great. The sectors in the American market that are doing best are technology, healthcare is starting to join in, resources are doing terrifically well, copper, uranium, other base metals, and of course, precious metals are looking good. So just go where the greatest degree of probability is currently residing. So that's it for this week. For any non-members, there's my contact details. I would love to hear from you if you would like some support, and I'll be back with you again next week. Cheers.